Everyone's piling into states like Western Australia and Queensland, but I'm putting my money into a state that's been abandoned for some time now, and that's Victoria. And in 12 months, I think you'll wish you'd listened to me. I'm Ben from Compound Property Buyers Agency, and we've been actively sourcing for our clients in Victoria for the last 18 months. We've been sourcing properties from as little as $220,000 up to $800,000, and I'm going to show you why. You may have read in the media that it's the wrong thing to be doing, but the numbers that we're buying on are going to show you otherwise. Here's what we'll be covering. First, I'm going to show you 3 data points why I think Victoria is set to boom. Second, I'm going to show you why areas like Brisbane and Perth are starting to run out of steam. And third, I'm going to show you the specific properties and property types that you should be buying in Victoria to get the most bang for your buck. And finally, why I think Victoria's 12-month buying window is closing fast. But before we get into it, I know what you're thinking. You're going to say, Victoria, with the land tax, with the low growth over the last few years, the terrible weather, but I'm going to show you why that's exactly why it makes sense. Let me start with the uncomfortable truth that may make you click off this video right now. And that is that Queensland, areas like Brisbane, Western Australia, areas like Perth, in my opinion, are overhyped. I know, everyone's telling you to buy there. And in fairness, we were one of those people telling you to buy there a few years ago. And every client that's done that did exceptionally well. However, markets don't last forever. If you look at cities like Brisbane, cities like Perth, they have performed over 100% capital growth over the last 5 years. But if you look back in history, you'll see these markets, like every other market, go through rapid growth cycles, which they're just currently in, and then they go through long, flat periods. In some cases, even they drop in price over time. So if you think about Perth before 2021, it actually hadn't grown for a good decade. And Brisbane was the same. It started moving around 2019, but prior to that, for a long time, it had done barely anything. And the reason for that is that every market has affordability limits. So if you think about it, property prices are technically tied to local income. So once a market becomes unaffordable relative to local incomes, then the market starts to slow down. And I think that that's what we're starting to see in some of these areas. Now, what most investors do is they look at these areas that have performed so well and think, perfect, I'm going to buy into that market and that's what I can expect for the next 5 years. However, that's not how it works. You're buying the future growth, not the past growth when you're purchasing an investment property. And right now, whilst everyone's fighting over those overheated markets, we're targeting the state that no one's talking about, and that is Victoria. It's called contrarian investing, and the reason is we're seeing it undervalued, overlooked, and the market primed for growth over the next few years. But don't just listen to me. Let me show you 3 fundamental indicators of why we're actively buying in Victoria now. The first one is market cycle timing. Now, this is the big one. So when I look at areas like Brisbane and Perth, they've done over 100% in the last 5 years. But some of these suburbs in Melbourne, and generally in Victoria as well, have only done 20%, 10%, some even hardly any movement in the last 5 years. Most investors will look at that and freak out. When we look at that, we start writing offers. And the reason for that is because we look for areas that in the last 3 or 5 years have not grown more than 50%. The reason for that is, like I said, you want to capture a large portion of a growth cycle in a market. So if an area has already performed at 50%, particularly in the last 3 years, it leaves limited upside for growth. Now remember, when I said that Perth and Brisbane were before their boom cycle, if you looked at their last 3 and 5 years, they might have even been in the negative at some point, and that would have been the optimum time to buy, and you would have experienced a full 100% growth cycle and still probably a fair bit more to go. The second indicator of Melbourne is the affordability metric. So like I said before, property prices are tied to local income. So if an income is capped, then the property can't keep growing just physically because people just generally cannot afford to buy it. So when we look at affordability measures, the way that we do it is how many years does it take to own a property in that suburb relative to local income. So when I look at what we would deem an unaffordable property, an unaffordable suburb, some suburb in Sydney, they might be a 40 to 60 years to own relative to local incomes. However, when I'm looking in Victoria, we're seeing areas that are 20 to 30 years, so significantly under the kind of 40-year threshold. And that means that there's a lot more room for price growth when the boom actually begins. The third indicator is supply metrics and market timing. So when we look for a market, yes, we want to buy early, but we don't want to be too early and be waiting for many years for that growth to occur. So one of the metrics that we look for is stock on market. So what percent of properties are for sale in that area? So typically the more supply that you have, the less price growth that you're going to have. And we're seeing metrics around 0.5% stock on market. So very tight. But most importantly is the days on market. So that is, how many days does it take to sell a property in a particular suburb? A balanced market is around 50 to 60. And that's where Victoria and particularly Melbourne was only about 12 months ago. We're now seeing that come down to 30 days on some of our metrics. However, on being on the ground, we're seeing properties sell as little as 7 days, sometimes even less. So the reality is the days on market is reducing significantly, which is putting upward pressure on prices. But property investing isn't just about what's happened, it's also about what's going to happen. And when I look at Victoria, if you look at the population growth and the infrastructure spend, you can see that it paints a very clear picture. Victoria, despite the cold weather, despite the land tax, is now Australia's fastest growing state by population. In fact, by 2051, they're predicting Victoria to have 10.3 million residents and Melbourne alone to house 8 million of those residents. So if you think about it, we've got a tightening supply, not much building happening, and we've got far more population coming into a state. You can see how it's starting to paint a picture. In fact, Melbourne has overtaken Sydney as our largest population city. And for the first time since 2020, Victoria is actually having a net population gain from interstate. So people are moving to Victoria as opposed to leaving in the masses, which we all know that they did during COVID. In fact, I heard the other day that Geelong, a very strong regional centre in Victoria, has more migration than the Sunshine Coast in Queensland now. It's the number one regional hotspot as far as population movement. And on top of that, we have what Victoria is dubbing the Big Build, which is a number of infrastructure projects across the state. We've got the Westgate Tunnel, the Metro Tunnel, and these are not small projects. These are multi-billion-dollar projects that are going to transform the state for the future. Yes, they've cost a lot of money, unfortunately, and it has affected the state debt, but long-term, these are going to really support the population growth needed. And just to add to that, employment in Victoria is at a record high, with unemployment sitting at a low of 4.5%. Meaning there's plenty of jobs, we've got more people moving into the state and large population growth, creating the perfect scenario for property investors. Now, I know what's been running through your head this whole time. You probably haven't even been listening. You've been thinking, Ben, but what about the land tax? Ben, what about the low rental yields? And Ben, what about all these harsh rental compliance laws that have come out? Well, I'm going to talk you through all three of those and why I don't see them as a problem. The first one, Victorian land tax is too high. And look, I don't like land tax, but I'm going to talk you through why it's not as scary as you think. So we focus on affordable properties. So we're talking properties, like I mentioned, between 200 to 800,000, and the land value is what land tax is calculated at. So if you're purchasing a property in Victoria and the land value is less than 300,000, it's going to cost you $975 in land tax. And look, these numbers can then change over time, but at the time of recording, if you're buying over 300,000 but under 600,000, it's about $1,650 for the land tax. And if you buy over 600,000 of a land value, you're looking at around $2,250 a year. So yes, it's not great, but at the same time, it's not a massive amount of money. Now, the benefit of Victoria is that when we were buying in other states like Queensland and Western Australia, they all have their own pros and cons. So the insurance is typically a lot higher in places like Queensland because you've got more weather events up there. Council rates can be a lot higher in parts of WA and in Queensland as well. And even things like property management is typically, like, you might get property management 8% in Queensland, you might get, up to 10% in WA, where in Victoria it could be 4 to 6%. So overall, the net holding costs of a property are actually very similar. Also, with land tax, it is a tax deductible cost, and it is what we consider part of the cost of doing business of owning a property. So it all comes out in the wash and not a reason not to buy an estate. The second one is the Victorian rental compliance checks. Everyone's saying it's unfair and it's not a good scheme, but in reality, as a property investor, you are providing accommodation to people and you want it to be in good order. Surely it's your investment as well. So as part of the laws, you need to provide things like a heater in the main room. You need to have blinds. You need to have smoke alarms checked and all these types of things. Yes, there is a small expense that you need to factor into your holding costs, but the reality is it's upkeeping your property and providing a suitable home for your tenants, which is actually a good thing. So not something that I'm concerned about. We're also seeing a lot of other states make the move and get a little bit tougher on their rental laws as well. So I do expect other states to follow. And the other objection is Victorian yields are low, and you are absolutely right. And no one loves a high yield more than me. However, what we've discovered is with different property types, you can actually navigate this. So we have three types of properties that we buy in compound property. We buy the cheapies, which are affordable villas, units, townhouses, typically between 200 to 400K. And we're finding them in Victoria right now, in Melbourne in particular, with yields of 6 to 8%. The other thing that we do is buy foundation properties. These are your houses on a good land content with a decent rental yield and a strong market. So we're picking these up in Melbourne between kind of 600 to 800K, yields between 4, sometimes up to 5%. And in regional Victoria, we're getting sometimes between 4 and 6%. So you can actually get a decent rental yield in houses in some markets. And the third thing that we do is legacy properties. So we buy commercial and residential unit blocks, and we're picking these up in Victoria with 6% net yields, or some of the unit blocks even 6 to 7% gross yield. So you can still get good yields in Victoria, but you just need to know what to target. If you go and target a blue chip house in some of the inner ring Melbourne properties, yes, you're going to be getting a 2 to 3% yield, but you need to be smarter than that when you're looking into the state. So the key is knowing which property types match your strategy to get around the yield. And look, if it was me, I would take a lower yield with a much higher growth rate over the next few years than a higher yield with flat growth, because really, what's the point? Another objection that I hear in Victoria, or particularly Melbourne, is there's too much land supply and there's too many buildings happening. And look, this is a legitimate concern. Melbourne and some pockets have way too much supply and way too much vacant land. So the way that we like to avoid it is simply that. We avoid it. We don't buy there. We buy in more established areas where we can measure the building approvals and make sure it sits under our threshold. So any objection or concern that you have can be mitigated through buying the right areas. So I'm going to show you some properties that we're actually buying for clients. And like I said, at Compound Property, we have 3 strategies that we target: the cheapies, foundation, and legacy. So let's have a look at what a cheapie looks like in Melbourne. Okay, if I pull this property up, you can see we are in the suburb of Melbourne East. Now, this is actually, I would almost consider a blue chip suburb. I couldn't believe it when we picked this up. So we paid $315,000 for this property. It's a 2-bed, 1-bath, 1-car unit in a low-rise red brick building, which is like what we like to target. So if you think about this, it still has a strong land content because there's only, I think, around 12 in the complex. So we paid $315,000 for this. It ended up renting out for $470 a week. So the yield was close to 7%. We got a bank valuation on this only a few months later, and it came in at $430,000. So this client was actually able to release their full deposit and go again. But this is a great example of an undervalued property in Melbourne at the moment, because for $315,000, it's well under replacement cost. You couldn't build a 2-bed unit, particularly in a suburb like this, for that price. Going to our foundation strategy now. So this is where we target freestanding houses on good blocks of land. If I have a look here, this is a 4-bed, 2-bath, 2-car in Craigieburn, which is a northern suburb of Melbourne. It's 25 kilometres from the CBD, and we were able to secure this property for $660,000 back in December 2024. So if you have a look here, it's a well-presented property, 4-bedroom, 2-bath on a good block of land, just over 400 square metres, only 25 kilometres from our largest CBD. The rent on this property was actually not too bad. The yield worked out to be about 4.5%. And you've obviously got things like depreciation and stuff too, this being a not too old house. So there was a lot of benefit, and it's very much a set and forget, which is what suited this client. So you can still get these properties. Now, we bought this for $660. I think we've had a bank val now about a year later coming in at $750. So you can see, if you read the headlines and say Melbourne's not growing, it absolutely is. But for me, at $750, it's still well undervalued, because if you compare something like this to an area 25 kilometres out from Sydney, you're probably looking at half the price, or maybe even less. And the third strategy we have at Compound Property is legacy property. So these are the ones that you want to buy and hold forever for the cash flow. So we're talking commercial property or residential unit blocks. And this was an absolute cracker. We bought this block of 6 units in what we would call a blue chip suburb of Melbourne in Elwood. This property, I think it's only like 3 or 4 minutes from the beach. We paid $2.1 million for this property. It's 6 1-bedroom units. The yield worked out to be about 6% or even just over. Now, what was most incredible about this property is that you're getting a good yield, you're getting into a really strong suburb, but the land value on this property, it worked out to be about $1.9 million. So you think we paid $2.1 million. The land value alone is $1.9 million. So we're basically getting a block of 6 units for free. So that's where I'm seeing really undervalued opportunities at the moment. So as you can see, these are real properties and real clients buying real good value properties, whilst everyone else is focused on the overheated markets that have already experienced so much growth. But here's what keeps me up at night. Victoria is starting to get a lot more attention. As a buyer's agency, we are seeing properties sell a lot quicker. If you're looking at the data, the days on market is getting a lot less. The people attending open homes is getting a lot more, and properties are selling with a lot more competition. I'm even starting to see clients come to us specifically wanting Victoria and Melbourne. I'm starting to read it on the news, and that's when you know that the buying window is closing. For me, I look at it and say the buying window is in the next 12 months, and that's it. After that, it'll be obvious to everyone, and it'll be the same like Adelaide, Brisbane, Perth. Everyone start piling in, and then that's when they say the dumb money comes in. So now is a great opportunity. If you could look back in time, would you have loved to have entered Perth in 2020 or 2021 and entered Brisbane in 2019 and entered Adelaide around the same time? Of course you would. And this is the opportunity that I'm seeing down in Melbourne and Victoria as a whole. Right now, whilst everyone's scared of it because of the low growth it's had, the low rental yields, the rental compliance, the land tax, all these things have scared off enough people, but the smart people are entering now. Property investing, like other investing, rewards contrarians. So don't follow the herd, go against the grain, and that's where the greatest rewards are in property investing. If you want help buying in Victoria before this window closes, there's a link in below to get in touch with us at Compound Property. We help clients with the whole process from strategy to acquisition, ongoing reviews, everything that you need to build a property portfolio. We're actively sourcing properties down in Melbourne and Victoria between 200,000 up to 800,000 whilst the buying window still exists. But whether you're working with us or not, take this information, use it how you will, don't follow the crowd because the real opportunity could be staring you right in the face. The question is, are you brave enough to take it?